Today's webinar is brought to you by the Sharpe Group. It's titled Philanthropy in 2016, Meeting the Challenges. It's now my pleasure to introduce your speakers. Robert Sharpe has helped many of the nation's leading nonprofits plan, develop, and implement successful major gift planning and endowment development programs. His remarks on charitable giving have been featured in leading publications and media, including the Wall Street Journal, the New York Times, Newsweek, Forbes, Smart Money, MarketWatch, the Chronicles of Philanthropy, Trusts and Estates, Kiplinger's, and other national media. He chairs the editorial board of Trusts and Estates magazine and authors a regular column on the philanthropic matters. Robert Sharpe is a cum laude graduate of Vanderbilt University and Cornell Law School. Barlow Mann has more than 3 decades of experience in charitable gift planning. Before joining Sharpe, he was Director of Development at the University of Tennessee Health Science Center. There he was responsible for current, deferred, and capital giving for the colleges of medicine, pharmacy, dentistry, nursing, and allied health. He's also served as Director of Planned Giving for the University of Memphis. Barlow has authored articles for national publication, including Trusts and Estates, the Journal of Gift Planning and Fundraising Management. He's also a frequent speaker on planned giving topics regionally and nationally. Barlow Mann is a graduate of Tulane University and the University of Memphis School of Law. And now, Robert, I'll turn this program over to you.
Well, thank you, Mary Jo. It's a pleasure to have you all with us this afternoon, or morning, as the case may be. We want to welcome you to Philanthropy in 2016. Barlow and I look forward to spending the next hour exploring a number of trends and other factors that we believe will have a significant impact on your fundraising for the remainder of this year and beyond. We're going to spend the first half of the session looking at some trends that are developing, some of which we hope will be new to you and helpful, and point out how they interact in different ways. And then Barlow is going to pick up with some practical advice and ideas for things that you might want to be looking at in the remainder of this year and for 2016 and beyond. All right, so we all know that we've spent the last 6 or 7 years in a period of fundraising environment that we really haven't seen since the Great Depression as far as the extent and duration of the decline in giving and the period of recovery. What we want to do is look at where we are now. Are we looking at pretty much the same environment going forward? Or are there some new things that we're not necessarily what we've dealt with in the past that we're not familiar with? Some people will tell you we're on the brink of this huge wealth transfer to charity and there's limitless money to be had, and that may be the case for many people. But the truth is, it's going to be good for some people, better for others, average for some. It's going to depend on how we gauge the world around us and how we adapt, interpret, and react to a number of trends. As we're going to see, this may be the year that we finally recovered in the terms of charitable giving, and we want to continue that in 2016. We've got an election year next year. We're going to have a lot of new congressmen and senators and a new administration come in. What's that going to mean? We've had 2 or 3 years now of discussion of tax reform, and everyone says, well, nothing much going to happen this year, probably next year. But we are going to get, I think, some pretty major differences in 2017. Along the lines of what we saw in 81 and 86 and 93, when we have a change of administration, we often see tax reform, and I don't think you're going to see that happen without some changes to charitable giving. Those changes are under discussion now, and we'll refer to some of them as we go along. Then we also have news reports about the 1% having all the wealth and stagnation for many people's incomes for a long period of time. That seems to be ongoing. And then we're going to have the largest generation in American history prior to the millennials all retiring, with 10,000 baby boomers turning 65, 70 in that age range every single day for the next 15 to 20 years. So all of these things are all out there, and we have to deal with them. Now, 2015 At the beginning of this year, there were people predicting that this could be a bad year for giving. They said, well, we're due for a market correction. The economic growth is slowing down. There's still a lot of uncertainty out there. All of those things are, in fact, true. But it looks like so far that for this year, we don't have any overall reports, just some early indicators. It looks like things have held steady. The third quarter, we did have a correction, and we had some clients that saw who turned out the lights in August and September when the market people were thinking, oh my God, are we going back into another one of these periods where we're going to see a big decline and then going back into a double-dip recession? We pulled out of that pretty quickly, and it looks like, from what we can tell, we're probably ending this year on a fairly strong note. So what are we looking at for 2016? Probably not a lot of differences from what we've seen this year. Probably pretty much a little more of the same, treading water, if you will, for 2016 while we go through the election cycle. I don't think we're going to see a lot of major changes on the horizon, but it's going to be, I think, for a lack of a better term, maybe a watershed year along with 2015. There's some major things happening, some shifts. All right, and again, we're going to look at these various trends, and they all are interrelated in a number of different ways. All right, the first thing we want to look at here is the recovery in charitable giving. It looks like, and let me say at the outset here, I'm going to give you data from 2014 from Giving USA and others. That's the most recent authoritative information we have. We're not through with 15 yet, and we don't have the numbers in for 15, but we're going to be looking through 14, and when we look at some of the tax-related IRS information, we'll be looking at some data from as late as 2013, which is the most recent numbers we have there. In any event, for 2014, in the report that came out in June of this year, Giving USA reported a record year for giving. And you see this 14-year trend. You can see that we took quite a hit in 8, 9, and 10, recovered, at least in nominal terms, in 11. The white space in that dip represents maybe $150 billion of lost revenue that we would have had the prior trend continued. Now, these are nominal dollars. As far as what we have to spend adjusted for inflation, and what Giving USA is always talking about, inflation-adjusted giving. When you look at adjusted for inflation, 2014 was the year that we actually got back above the 2007 levels. So the period between 2007 and 14, 8, 9, 10, 11, 12, 13, all of those years, we were actually in real terms raising less money nationwide than we were in 2007. Now, most of us on this call, most of us on the webinar, are dealing primarily with individuals. Some of us are responsible for corporate and foundation giving, but we're going to focus mainly on individuals because there's a different picture when you look at that. When you look at individual giving overall, according to Giving USA, inflation-adjusted giving by individuals, we are still below 2005 levels. 2005, 6, and 7 were a peak. Then we had a big drop in there, and then we've been recovering 2 years down, then a recovery over the last 5 or 6 years. We hope that 2015, you only need a 4% growth this year in individual giving in real terms to get back to where we were. At the beginning of the recession in 2008 or 9, some people predicted that it could be 2016 before we fully recovered from the effects of the economic downturn. And it looks like, in retrospect, while we didn't want to hear that in 2008 because it was 8 years away, here we are, it's done, we're probably back where we were, and the question is, where do we go from here? Going back, when the crash started in 2008, we went back and did an extensive amount of analysis of what happened during the Depression, because when people like Alan Greenspan are saying that we might have an economic disaster that we hadn't seen in 100 years, going all the way back to the panic of 1908, we thought it might be a good idea to see what happened. Well, what happened during the Depression was very similar to what we just saw. not much of a change in 29 and 30 and 31, but then a 2-year drop followed by a 7 or 8 year recovery period, and it took till 1941, about 9 years, to get back to where they were in 1931, 10 years. So not quite as bad. The dip was a little bit lower, but the recovery also took 6 or 7, 8 years. Now, while we've recovered, the sources of giving, where we're looking to based on wealth of individuals and generational groups and regional and other things, we're seeing some shifts in some areas that I think are of interest. IRS data is the best data we have for really tracking giving by age and by economic levels of wealth and income. You may say, well, only about a third of people itemize, so why should we pay that much attention to that? Well, that's because year after year after year, the 30% or so who itemize account for 80% of the giving is reported by individuals in Giving USA. Putting that in more light, that third is only about 16 to 18% of the U.S. public giving 80% of the money. So Pareto's law comes into play, and about 80% of the money is coming from those 20% of adult Americans who itemize. If you look at the most recent year that we can compare both, you had $240 billion reported by Giving USA from individual giving, and of that group, $195 billion roughly was itemized on tax returns. So if you look at it visually, you can see that what's going on with itemizers, I think is worth paying a lot of attention to. I know that the Giving USA numbers routinely go back and compare their 2 years later. They go back and take a look at itemized giving just to see if they were in the right range, and they track very, very closely. So the amounts that we see on tax returns are very important, and as of 2013, the amount that had been deducted on returns looked very similar to the overall picture, had not quite returned to normal. What we'll probably see is that by when the 14 and 15 numbers come out, hopefully we'll see the full recovery there as well. But we're just about back for the most recent years we have. Again, here's the total giving reported by Giving USA here, and here's the amount itemized, and you can see they correlate very strongly. All right, again, just to come back to tax policy, don't pay a lot of attention to people who say, oh, well, don't worry about what's going on with the tax deductions and tax incentives. After all, it only applies to 30% of the people. Well, it's the 30% that are giving you the bulk of the money. All right, there's some really interesting information that we can glean from what the IRS reports as far as giving is concerned. Was this decline in giving during the recession just across the board? Did everybody reduce their giving? Or were there differences based on wealth levels? Most people might think, well, you know, in a recession, the really wealthy, they don't get hit that bad. They continue to give. It's those people who lose their jobs, the unemployed people and whatever. So it's the masses of people who cut their giving, and the middle class gets hurt, cuts their giving, but not the wealthy. All right, let's see where the declines actually occurred. This is again, from 2007 to 13, this is the amounts deducted from tax returns according to the IRS. Now, look at what you see when you look at people with income under $100,000. This would be people that have one income of $100,000, two incomes of $50,000, one for $60,000, one for $40,000, whatever. It's household income. No big change. In fact, they even, as in the beginning of the Depression, look, in 2010, that group actually increased their giving, just like the masses of Americans increased their giving in 30 and 31 as a response to greater needs that were being felt. All right, and again, these numbers are lagging by 2 years because of the most recent ones we have. All right, now look at what you see when you look at 100 to 500,000 in income. Now, this would be one person with an income of 150,000, or two people with 75 each, or two people with 200 each. This is the broad mass of American upper middle class taxpayers. They just barely decreased their giving in 2008 and then increased steadily right on through the rest of the recovery. The same thing happened, by the way, during the Depression. The people in the middle income ranges did not cut their giving according to the IRS, even back at that point. But let's see what happens when you look at amounts with incomes over $500,000. Here's where the big hit was. Those people gave $63 billion, about a third of the total given in 2007, and their giving dropped by 33 or $34 billion. As we'll see, that's basically the entire drop. And that group had not yet recovered as of 2013. Hopefully, we're seeing more major gift activity now, and that group is coming back. But the point here is that the decline in giving was apparently not across the board. And this now explains why, at the time, some of our clients that were mass-oriented with millions of small donors, they're saying, we're not really seeing that big of a hit. In fact, one of them only saw their growth go from double digits to single digits. Whereas we were hearing other people who were relying heavily on major donors and wealthy individuals, they're like, what's going on here? Our giving's down 15, 20%, 2 years in a row. Well, we couldn't figure it out at the point, but now we know it's because of what was happening with the really higher income people, and we'll shed a little light on what caused this in more detail in a minute. But again, there's the amount deducted, the decline, and it basically was all concentrated with people over $500,000. Donors with incomes over that level accounted for 80% of the decline in giving. Look at this. The total decline in giving was $35 billion, and $29 billion of it, a 44% drop with the wealthiest donors during the recession. And the other, again, between 2007 and 9, there was a drop among the lower income individuals on this chart, but it wasn't anywhere near. And you can see 29 out of 36, 80% came from this higher income group. All right, the good news is this same group has brought us back in recovery through 2013. Looking at the increases in giving by wealth levels, the total increase is $36 billion, a 23% increase in giving by individuals, itemized giving in that 4-year period, and there was a 66% growth in the over 500,000 level. Now, the under 100,000 still is around even or down 3%. So again, we didn't see a lot of growth, a lot of decline there, not a lot of growth. That group is soft through 13, but we can see the higher income people have been leading the way. All right. To summarize this part, looking at it from another perspective, which is an important one. If you look at all the itemized gifts in this country now, about half of them are coming from people with incomes over $200,000, and the vast majority, as could be expected, with incomes over 50. Now, why is this important? Because the over 200,000 group, that should sound familiar to some of you who've been following tax reform proposals, because the people who want to limit the economic benefits from deductions for charitable gifts, they say, well, we only want this to apply to people with incomes over $200,000. Well, I'm here to tell you that's probably half the giving is affected, and even if half the giving reduces by 10, 15, 20% because a person making giving a $100,000 gift, if they can't deduct it, would have to make $130,000 pre-tax. That's a big increase in what it costs to make a gift. Or if you just say we can't deduct beyond 28% and we're only going to have a 12 or 13% excise tax, you still have to make $116,000 to net the 100. So there are big issues in play here. So pay attention to what's going on with the proposals for the higher income individuals. It's important. So watch for that. Some of the proposals that are out there, some of the presidential candidates would do things like increase the standard deduction so high that virtually no one would itemize except the very wealthy, and get rid of the Pease Amendment. And actually, under those proposals, wealthy individuals over $200,000 in income, they would get more benefits for giving than they do now. Others would do the opposite and cap the benefits and leave all the benefits for lower income individuals and limit them for the top. And it's all over the board, so just stay tuned on that one. All right, related to this is the investment market and how that's been driving a lot of the activity. All right, we can look at IRS data also, looking at the rise and fall in giving and how it relates to investment values. Again, here's our amount deducted from tax returns from 1996 to 2013, roughly a 17-year period there, and look at the Dow during the same period. Okay, if you look at these two things together, you can see that the declines in non-cash giving, and remember, there was decline in 500,000 up income and a decline in non-cash giving. Look at the non-cash gifts. Again, from close to $60 billion to a little over 32. There's $28 billion of the 35 in those 2 years. This was a investment market, high-income, wealth-driven recession in giving, highly tied to the markets. It didn't get picked up in some of the early indications in 2008 and 9 because at that point we knew there was a wealth effect that gradually increased giving as market values increased, but we didn't necessarily, having had no experience with this since the 1930s, we didn't know just how big, how fast the wealth effect would drop when people saw the Dow drop by 50%. Well, the giving among the wealthy dropped by 44% as the Dow dropped the same way. So this drop right here was tied greatly to the recession, to the drop in the markets. So here's your Dow Jones Industrial Average, and here's your non-cash gifts deducted, and I guess there's a lesson here to be learned. Now, if you then last part of this, if we compare the giving among high-income people and people who gave non-cash gifts, very similar. We had, again, a 44% drop of $28 billion in giving by people with incomes over 500, and non-cash gifts dropped, look at that, 27 versus 26.9 versus 28.9, almost identical decline. So it's pretty clear, it should be coming pretty clear where the decline came from and where the recovery is coming from, and some implications about what some of you may want to do in the next few weeks that Barlow will be talking about soon. All right, looking at the recovery, again, people with incomes over 500, their giving is up 66%, whereas non-cash gifts are up 62%. Now, I'm not a statistician, a mathematician, but even with my limited analytical skills, I seem to see a pretty close correlation there. All right, what does this mean? Fundraising may now be stabilizing, but we're going to be needing to pay a lot of attention to the wealthier donors as the wealth effect comes back on. It takes, again, it doesn't take very much, doesn't take a whole lot of water to put a fire out. But once you let it dry out and start another fire, it takes a while before you get to the same level of intensity and heat as what you had before the water got thrown on it and put it out almost immediately. So we've got to keep nurturing and understand that it may be 2 or 3 more years before we get a complete return of the wealth. Gifts of appreciated securities and real estate are probably more important even than we may have thought. In fact, going back and looking at it, in many years, looking back, the amount of appreciated property gifts deducted from tax returns is more than all the bequest income. Now, I'll just query whether any people on this call are spending anywhere near as much time talking to their donors about the right properties to use to make their gifts as they are encouraging bequests and other planned gifts. I'm not saying don't encourage the bequests, but I'm saying that we may very well want to have an emphasis on some of the other ways of giving as well. It's still not too late, even this year, to get the message out to the right people. So again, Barlow will be focusing on that in a minute. You want to remind the right people of the benefits of this, and don't assume that people understand that they should be giving something other than cash in some cases. There's a study that was done back before the recession by AFP and Fidelity, and they found that even among highly wealthy individuals with 50,000 Fidelity households with a lot of stock, any of whom could have given $10,000 in stock easily, only 68% had any awareness that there were any tax advantages, even when they were told and reminded they couldn't see any reason. So again, just keep in mind that sometimes when a donor is considering a large gift, or in rare cases, perhaps someone sends a check for $20,000. I know it's not possible in many cases, but where you can, you might just want to hold that check for a few minutes or a few hours and call the people up and say, hey, if you have any stock that's worth more than you paid for it, you might be better off to give that to us and let us tear up this check, and you use the $20,000 to go buy the same stock. Perfectly legal, not something that people wake up in the morning thinking about, though. You have to point it out to them. Another trend that we're seeing is a lot of donors are actually a lot older than we know. Now, we spend a lot of time analyzing donor bases for our clients, and we find, surprisingly enough, that very few organizations have large numbers of donors much under 60 years old, and virtually none have the bulk of their base under 45. We just have thought that was maybe due to the fact that we're dealing more in the major and planned gift area, and maybe there's a lot of other giving out there that we're not really tracking, and some truth to that probably. But we also can look at IRS data and see this is what really surprised Barlow and I. We've seen a lot of data over the years, but this is something that we did not know until very recently because the IRS started reporting some of these deductions by age ranges as well as AGI. It looks like if you look at the $194 billion that was deducted in the most recent year, $63 billion of it, or 32% of it, came from 7 million people over 65 who itemized their tax deductions. Now, there's 243 million Americans over the age of 21. We're looking at about 2% of the adult population over 65 who are itemizers that are giving a third of the money. And if you look at the average donated, it's $8,200 per return, which is 40% higher than the closest age range. And if you look at cumulative percentages deducted, you'll see that people over 55 are giving about 60% of the 80% of individual giving, or about half the giving is coming from itemizers over 55 and a third of it over 65. So don't ignore, again, counterintuitive. People may think, well, people are retiring and they don't have the money they used to have to give. Not necessarily. People give out of discretionary income, and sometimes people, when they're retired, they've been there, done that. How many more times can you cram yourself in the back of the 747 to fly to Paris? That money is there in the bank account. They're not traveling as much. They're not spending as much on entertainment and clothing. Other studies show that the percentage of wealth devoted to charitable giving is one of the only things other than healthcare expenses that increases by people over 65. Again, visualizing this, it's pretty clear that 65-plus group, we need to be paying attention to that and paying attention to what's going on in the last quarter of people's lives. In the 65, 70, and older age range, that's where a lot of the giving is, and a lot of charities are leaving the field in the fourth quarter and wondering why they're losing the game, because they're not paying enough attention to people. They may give in different ways, in different timing, but they give, and the 55 and older group is by far the majority of the money. All right, let's look at non-cash gifts again, tying this back. I told you these things were all interrelated. Well, there's an age dimension to the non-cash dimension, which is driving the increase and decrease in giving. IRS data shows that people who give securities gifts tend to be older. Why? Because these are people, if you're 75 years old, you were 40 years old when the bull market started in 1981. These people took the whole ride. And as a result of that, it appears that people over 65 are giving 60% of the stock gifts, and people over 55 are giving 80%. And 63% of the numbers of people who give stock gifts are over 65. So a picture should be emerging here that we need to be paying attention to people over 65 that are wealthy, that have appreciated property, second homes, other kinds of properties that are out there, including, of course, their stock holdings. All right, there was a hidden wealth transfer in the 2000s. Everybody said, oh, all these people are going to die and leave money to young people. Well, what really happened? Well, interestingly enough, during the decade of the 2000, first decade of this century, the biggest losers were people 35 to 44 in change in median net worth. And look at this. The only people that had any increases in wealth were over 65 years old, and the highest increase was in people 65 to 69, which is an incredibly interesting thing given the fact that the oldest baby boomers are now 68. Many of the people in the later silent generation and early baby boomers, they're the ones where the wealth transfer went to because they were the ones that got all the run-up in the market from 1,000 to 17,000. The Dow was at 800 when Ronald Reagan was inaugurated in January of 1981. These people have been accumulating money for a long time. So while the overall country saw a 7% decline in net worth, again, look at the 65 and older group. They asked Willie Sutton, why do you rob banks? Because that's where the money is. Well, it should become pretty clear to you where the money's going to be for the next few years. All right, I created this term that I'm referring to as the gerontophilanthroplutocracy. This is a long word, but what it means is basically that we're going to be dealing for the next 10 to 15, 20 years with an older, wealthy, philanthropic group of people that have different ideas than the ones that came before them. The baby boomers had a lot of ideas in the 60s and no money, and a lot of them have now got money and ideas, and they cut their hair, went to work, made some money, and now you better pay attention to the gray ponytails who are sailing their boats out there and having their retirements and thinking about what they want to do to voluntarily reinvest some of their wealth in society. And they're not going to do it the same way that the Mad Men, Silent Generation, Joyner group did. All right, there are implications of this touch everywhere. Outright giving, people making pledges and gifts over time, and people who are giving through estates. So that's the overview of what the major trends that we see interacting. I'm going to turn this over to Barlow now, and he's going to address the question that some of you may be thinking, well, what do I do about this? What do I do tomorrow? What do I do next year and in coming years? Barlow?
Thank you, Robert. Again, the questions that we'll be answering over the next 20 or 25 minutes will deal with the trends and factors that Robert mentioned. And while 2015 is almost over, there may well be some things that you can do during the final weeks of the year. But more importantly, you'll be developing, hopefully, strategies to deal with these trends that will impact your fundraising in a positive way in 2016. Probably the best place to begin, based on Robert's comments, are going to be to segment your file. We know that the age of donors is very important. And we also know from Robert's comment that the wealth aspect is very important. And we believe that if you can start by looking at both age and wealth, you can create buckets or a matrix, if you will, that you can put every one of your donors in. Just like all of us, all of your donors are either younger, middle-aged, or older. Some of your donors are very wealthy, others are above average means, and some are of average or below average means. And so you've got your younger, middle-aged, older group that are either wealthy of moderate means or limited means, and different people will approach their philanthropy depending on a combination of both their age and wealth. In the chart that's on your screen, we've also added the generational elements, and roughly you've got the Gen X and millennials among the younger group. The baby boomers comprise the middle-age group, and then the older or mature donors are divided among the silent generation and the GI generation. That same matrix, we can include different gift options, and one option that's in every box are gifts of cash. And depending on your wealth, you can make larger gifts of cash or smaller gifts of cash. But also, depending on your wealth, the wealthier you are, the more options you may have in terms of considering things like gifts of appreciated securities, life income gifts, charitable lead trusts, and other gift planning arrangements that provide either you or charity or your loved ones with additional benefits. We'll start by looking at some of the different opportunities with outright gifts. And again, this is going to relate partially back to what Robert raised with the trends and the fundraising environment that we've been in since the Great Recession started and the recovery since then. Non-cash gifts are going to be extremely important, and in fact, if we look at 2015, it's probably going to be the performance of non-cash gifts that will propel individual giving back to the highest level since before the Great Recession started. So again, right now the Dow and other indexes are trading in a relatively high level in terms of their performance for the year. 2015 has been a relatively flat year, and the jury's still out to see whether we're going to have a positive performance, a small positive performance or small loss for 2015. But regardless of where the Dow ends up, there's a much larger amount of appreciated securities out there than there was in the second quarter of 2009 when the Dow was around 6,500. So long as we're in the $17,000 to $18,000 range, the supply side will help drive more gifts of appreciated securities. Similarly, real estate has recovered in most parts of the country and is reaching new highs in some parts of the country. In terms of real estate gifts, you're probably a little bit late at this point for 2015 unless the gift is already in the works. But real estate, again, may be something that will help drive non-cash gifts. Normally, it's the second largest segment of non-cash gifts according to the IRS figures. And then there's other valuable assets. People tend to give you what they have, whether it's art, collectibles, intellectual property. Whatever they've accumulated, they can give to you during their lifetime or afterwards. Again, non-cash gifts are critical. There's every indication this is where the large part of the recovery has come from since the lows that we're seeing in 2008 and 9. And again, this should be the factor that's going to cause new highs in individual giving, where we'll finally surpass the levels that were reached in 2005, 6, and 7. The wealth effect, it's hard to say it's going to be fully in play in 2016. We're still going to have a lot of volatility, and there's a lot of uncertainty there. What we do know from evaluating tax return data and non-cash gifts is that the wealth effect went away a lot faster than it came back. So we're just going to have to wait and see. If there's a significant market correction, that could deflate the wealth effect in 2016. But many of the stock market predictors are indicating that we're going to have the Dow with a modest growth in 2016. And if that holds true, again, the supply of appreciated assets will help drive the wealth effect, which will impact giving. The tax benefits are also stable for the near term, and those highest income and high net worth individuals may find that the benefits are greater than they've been in the past as a result of tax rates that they're subject to. Another key factor that we identified or trend was the fact that many donor bases are older than most people realize, and that we need to focus on the 65 and older audience. There are all kinds of reports that tend to indicate that people embrace their philanthropy in their 60s and 70s. And again, that's a group that should not be overlooked. While they're smaller, the silent and GI generation, the numbers of that group are relatively small. We're going to see a growth in that group because the baby boomers are increasingly adding another 10,000 people a day to that particular segment. Note the ages of the largest donors in 2014. The largest gifts in America, most of these gifts are coming from the older age segments, In fact, when we look at the over 70 age group, almost 60% of the gifts came from that group. And on the other hand, only a relatively small number of gifts came from, the largest gifts in America came from people under the age of 50. While there have been some very highly publicized, extremely large gifts from the younger group, and that should be encouraged, recognize that day in, day out, the older group year after year tend to make the majority of the largest gifts in America. They simply had more time to accumulate assets. And again, that simply emphasizes that particularly over the 60 age group accounts for almost 3/4 of the gifts of the top gifts in America. Again, the mature donors, the group is going to explode over the next 20 years, driven by the baby boomers. There are 10,000 baby boomers turning 70 every day. There's another 10,000 turning 65. There's 70 million people that are going to be entering that third phase of life over the next 20 years. And we also have to be attuned to other changes in society. You've got to be attuned to modern families. It's no longer the traditional nuclear family. We're seeing all kinds of hybrids out there. One quick example is that baby boomers are twice as likely to be childless as prior generations. And we all know what, from a plan giving perspective, your best prospects are childless. But from a concurrent giving process, that's also an important indicator. Because people give from discretionary income and assets, and it costs a lot of money to raise children until they're launched. And the number of people not having children are going to create wealth for those individuals or those families, some of which will be given during their lifetimes, and some of which might be given at death as well. There was an interesting study that came out several weeks ago predicting a major wave in giving by baby boomers. While most of the giving will be in the form of lifetime gifts for the foreseeable future, there's a heck of a lot of money that's going to come from that generation, and really we're at the leading edge of that right now. The study that Merrill Lynch released in cooperation with Ken Dykewald's company, The Age Wave, is called Giving in Retirement, America's Longevity Bonus. And the whole idea is that the over 65 group has traditionally been a pillar of philanthropy, and now that age segment in the U.S. population is getting ready to grow substantially, which will impact philanthropy in terms of outright gifts, volunteerism, and eventually in estate gifts as well. One thing that's on a lot of people's minds is the IRA rollover and what to do this year as well as next year. Again, we have a relatively limited amount of time to act, and Congress has failed to act once again. This week there's been a H.R. 34, which is intended to be an amendment that could be attached to other legislation, which is expecting to be passed in the next week or so. But at the best, we're probably looking at a enactment of the IRA rollover provision in mid to late December. So there's not much time to do a lot with that opportunity. The H.R. 34 would not only retroactively extend the charitable IRA rollover for 2015, but it would also extend it for 2016, and we expect eventually that will be passed. In terms of the future, next year the first baby boomers are turning 70. They're going to be at the age starting the year after next where they're going to have to be pulling money out of their IRAs. And assuming the charitable IRA provision is extended and made permanent at some point in the future, this should be a growing source of funds. But right now we're stuck with uncertainty again. And many of you probably have emails and other things like postcards queued up and ready to go when the law is passed. But unfortunately, many of your older donors over 70 and a half have already taken their minimum distributions this year. It probably would be a very good idea to dust off your list of prior charitable IRA rollover donors, particularly those that have made larger gifts in excess of $5,000 or $10,000 or $25,000, and certainly the full $100,000 to contact in the next few weeks, assuming Congress acts. The baby boomer generation will be the first generation to spend virtually their entire working career with these tax-deferred plans, IRAs, 401ks, 403bs, and so retirement plan gifts will be growing. But we're just at the leading edge of that at this point. And we also need to take one more moment to think about what to do this year. If the IRA rollover is not extended and donors are contacting you, many advisors are simply saying, go ahead and make their transfers. In many cases, the plan administrators will go ahead and process direct transfers to charity. And if there's a problem with the plan administrator, it's also possible simply to write a check on the plan in many cases. And earlier this week, we were talking with a client, and they had a high-income donor over 70 that was going to explore having his plan administrator issue checks so he could do just that. For the most part, they probably should not exceed their mandatory withdrawal amount, and they need to match the amount given to charity with that amount. And if the law is not extended, that amount would end up being recognized on their return, but in most cases the amount is going to be of a size where it would be deductible and offset the income that was reported. So it may be a win in either direction. But meanwhile, uncertainty is the biggest problem we have at the moment with the IRA rollover. And again, we just went through that. Meanwhile, the tax laws, overall tax laws, may never be more favorable than they are today. Most people that itemize, those that account for 80% of individual gifts each year, their gifts are treated the same way they've been treated since the Bush tax cuts were enacted back in 2001. For those that are in the very highest income and wealth levels that are subject to relatively high brackets, their gifts may actually save them more than under prior tax law. Now, meanwhile, 2016 may be the last time they have an opportunity to take advantage of these rates. If any of the tax reform measures that have been discussed gain traction and are passed, they could be passed as early as 2017 or 2018. That creates a future that may or may not hold the same level of incentives, which means we may have a bird in the hand situation for 2016 where donors that are interested in lowering the cost of their gifts or increasing the benefit for those gifts would like to take advantage of the existing tax incentives. And there's also been an increase in the estate tax exemption that was a few years ago made for gift and estate tax purposes $5 million indexed for inflation. Next year it will be $5.45 million per person, so a couple could pass almost $11 million without being subject to estate taxes. In some cases that may lead some people to accelerate a bequest that will no longer generate an estate tax deduction into a lifetime gift that could generate a variety of benefits, including income tax savings, capital gains tax savings, and perhaps an increase in their income. Don't assume your donors know about all these things. Right now, they're hearing a mixed message about tax reform. Most people are assuming that at some point there will be tax reform, but they don't really know what that means, certainly in terms of their charitable gifts. So making current gifts effectively can be challenging, and we need to communicate to donors and and really throughout all your gift planning and other gift development marketing efforts, particularly in 2016, so that donors understand the opportunities that exist. A quick example would be to make sure that donors understand things as simple as bunching their deductions. Again, an older couple has a relatively large standard deduction, and their itemized deductions may be close or slightly less than the standard deduction, so they end up taking the standard deduction. By timing their deductions, they may alternate between taking the standard deduction in some years and itemizing in other years for greater overall tax savings, for significant savings. Again, at this point, many people are engaged in last-minute tax planning, and if they're going to bunch this year, additional gifts would be advantageous. Or next year, if they anticipate that the tax benefits are going to be reduced as a result of tax reform, people that have not normally, quote, bunch deductions may be trying to accelerate gifts into 2016. Let's spend a minute and look at different types of gifts. As Robert mentioned, some gifts occur over time. We had outright gifts. The timing of gifts will vary depending on the individual's personal circumstances. They may make an outright gift, or they may structure a gift as a pledge or over some other time period. In some cases, those may be gifts that will be realized over a relatively long time period, or a combination. They'll be blended in terms of outright gifts, gifts over time, and then gifts that perhaps only occur at death. Ultimately, as fundraisers, our goal is to try to minimize the delay in terms of receiving the gift, but ultimately we're relying on the donor's individual circumstances. There are lots of tools that can help donors meet their personal and their philanthropic goals, and some of these can result in now gifts to charities. Since 2000, the Charitable Lead Trust has been the most rapidly growing type of charitable trust, and that provides now money to charities, and they can be established for a term of years or for life. And these gifts are beginning to be covered more frequently in the popular press. Here's an article that occurred just a year ago in Forbes magazine, highlighting a couple of Duke alumni that had established a lead trust to basically time wealth transfers, not only to charity, but to family members. The same article mentioned that another Duke alum, the IRS commissioner, had established a lead trust. So this is not some kind of esoteric tax gimmick. It's something that is, again, becoming more and more mainstream. We have a limited time today, so we're just going to highlight a few of these different types of examples. And the lead trust could be a better alternative than a private foundation or donor-advised fund for some donors. Instead of permanently disinheriting their heirs, a lead trust provides an opportunity to provide for charity first, and then have the assets returned to their family when the right type of lead trust is structured. Again, they're typically being set up for a term of years to supply income to charity first, but there are other plans, charitable remainder trusts, that can be set up to provide an income stream to the donor or others the donor designates. Again, with the supply of appreciated assets and the age wave, with a growing number of people entering the right age range for these types of gifts, we anticipate greater use of charitable trusts in 2016 than in recent years. Gifts of real estate, donors can also retain the use of that property, either a residence or farm, for a number of years or their lifetime. And we've seen a pretty significant increase in those types of gifts in the last several years. Virtual endowments are another way where donors can combine their desire to see a gift operate today while eventually endowing that gift. It's a way to give now and later. Oftentimes the donor makes a large overall commitment, but they'll perhaps make a pledge based on the expenses necessary to fund a particular program that would also eventually be paid off, perhaps upon the sale of a business or some other event 5-10 years down the line. And again, it could simply be backed up by an estate commitment by a relatively young donor that would rather see their gift work and, in effect, could start making gifts based on your organization's spend rate. So if they're trying to provide a program that would need to be funded by an endowment that would generate $25 or $50 or $100,000 a year, they make a long-term commitment to eventually endow that program, but they start providing the $25, $50, or $100,000 a year now. And then finally, we have estate gifts, and a little bit of background here. Estate gifts, we've had a little growth really over the period from 2000 to 2014. The large year we had in 2008 was largely the result of a handful of billionaire estates that were largely designated for charity in that year. When we look at the figures overall, though, we've been relatively flat when we look at a 10-year average. And so the growth has been stagnant at best in real terms over the past decade. Again, let's take a closer look at some of the underlying factors of why that has occurred, and the big one is a major demographic factor. The Great Wealth Transfer was based partially on predictions that the number of deaths would increase every year based on census projections. It turns out that did not really occur. Those projections, we had relatively flat death rates over the first decade of the new millennium. And in fact, in some years we had decreases in deaths that were the largest that we'd seen in deaths since the end of the Second World War. Right now, around 2010, we're finally seeing the number of deaths in America begin to increase just a little bit. In terms of the future of bequests, the oldest baby boomers are 69 years old, and most of them are going to live for decades more, but still they're going to begin passing away in larger numbers in 10 or 15 years, and then in fact the deaths of the baby boom will peak in 25 to 30 years, but we can expect a gradual increase in the number of deaths each year, which will begin causing, if a certain number of people include charities in their estate plans, it's going to create a rising tide that should generate more charitable estates. And if household net worth stays strong, we'll see an increase in bequest revenue. But it'll be very gradual initially, and it won't peak really for another 25 or 30 years. The future of bequests is bright. But don't jump to the boomers. Most of them have 20-plus year life expectancies, and again, the real benefit from that generation is 25 to 30 years out. In the meantime, if you're trying to see an increase in estate gifts, you're going to count on people that are passing away in next year, and the year after, and the year after that. And most of those deaths are going to come from the silent and GI generation, from people that are already over the age of 70. And that's the group that we need to focus on over the next decade. Researchers have determined that most of the wills that contain gifts to charity are really, the operative estate plan is only made after the age of 75. And all of the people in that group are members of the silent or the GI generation. Again, other changes are taking place that's going to affect bequests, and part of that's going to be where gifts are accelerated during lifetime. We're going to find that the $5 million exemption, very few people are going to get estate tax benefits for these gifts, and as a result, we're going to find that a growing number will have more to do with as they please to provide for their spouse, their family, their loved ones, and the charities that they care about. And while some of those gifts will be coming through their will or other simple estates, others will be accelerated during their lifetime through things like current and deferred charitable gift annuities, charitable remainder trusts, life estates and farms and personal residence, and all of those things generate, at least under current law, additional benefits that the taxpayer would not receive if they waited and made those gifts at death. There's some indication that as interest rates increase, there may be renewed interest in pooled income funds as another option. Gift annuities can be very attractive in today's environment. Lower interest rates are stimulating interest, and it's a way, if you have an older person that was planning on leaving you $10 or $20 or $30 or $50,000, they're going to do something with that money. And if they've been looking at ads like this where they might buy some kind of a reverse mortgage or commercial annuity, charitable gift option might be something they would prefer to consider. We can generate a current income tax in effect for a bequest for these donors. The same is true with charitable remainder trusts. We have this huge group, again, based on studies that we've done. We found that the average age for one large group of charitable remainder trusts was around age 68 to 69, and the IRS data tends to support this by indicating that the average length of time that charitable trusts are in existence are in the 13 to 15-year range, which coincides with individuals or couples in their late 60s or in their 70s. At this point, we've rolled up to the end of our hour, and I'd like to turn things over to Mary Jo, and we hope that you've enjoyed the presentation, and we look forward to answering a few questions if you do have some time.
Well, thank you so much, and that does conclude this program, Philanthropy in 2016, Meeting the Challenges. It was brought to you by the Sharpe Group. Thanks to our speakers, Robert Sharpe and Barlow Mann. Now, if you have questions that didn't get answered today, I know there were some, just email them to info@sharpenet.com. You can see that on your screen right now. Today's program is copyrighted in 2015 by the Sharpe Group, all rights reserved.